This is part 2 of this particular lecture. You'll see that there's a little white box over there with 4 questions. I'd say that if you cannot answer those questions, or there's at least one of those questions you can't answer, you may want to go back to part 1 and catch that section of that lecture for what you do not know the answer to. Otherwise, for those of you moving further in, the first slide is sort of a repeat, but after that, we're going to be getting into some new material and we're going to be looking at the market for loanable funds and how government policies affect basically that marketplace. So let's get started. I liked this definition of the financial system because the truth is that the financial system in one way is pretty simple. It's just matching people who want to save with people who want investments or want to borrow money. And so you may remember Marco. Marco came in an earlier lecture. He was a gentleman who was about getting ready to graduate from college. He put some money into the bank because he wanted to have a big party after he finished college, and he knew that if he took this money, put it in the bank, he'd get some interest, and then he might be able to have more people at his party. Well, he is what we would call a saver, and savers put their money into the system when they deposit their money in banks, or they could deposit in mutual funds, and this group is called a financial intermediary. Or instead of putting it into a bank, he could have invested the money right into the bond market or the stock market and be receiving some sort of reward for doing that. Now, from financial markets, you can see sometimes the bond market may go and put their money in the banks. Sometimes the stock market, the money is actually going into a mutual fund. But either way, eventually this money is going to come to borrowers. So a borrower in this case, here is Ramona. A borrower can be an individual, it can be a business, or it can be the government. And borrowers are using this money to create some sort of capital, you might want to say. So if Ramona as the individual is a borrower, she might want to buy a house. And so she goes to her local bank and she gets a mortgage. Well, what a mortgage is simply borrowing money from the savers. I mean, the bank itself got all of its money from all the people who save or put their money into that bank. And the bank says, we're going to give you X amount of interest, or maybe no interest at all, but they're going to give you something for holding the money. That money then they're going to turn around and lend out to people who want to buy a house. And that's why Ramona has to prove that she has a high enough paycheck, or she is a risk that the bank should take, because basically the bank is taking the risk on the behalf of their savers. She could be starting a business. Perhaps she's starting an international trade business, and to start her international trade business, she's going to need a warehouse, and she doesn't have the money for a warehouse, at least not right. We need to quickly address 2 words that in economics are common words for economics, but also are common words out there in the real world and have lots and lots of different meanings. And so in economics, when we look at accounting, we tend to use the definition of the various ways numbers are defined and added up. So we're not looking at the process of doing it, we're looking at the definition of how we define each word. And another word that, again, is used in various ways is identity. And so when we're talking about identity in economics, we're really talking about more the mathematical type of definition, where an equation has to be true on both sides. So let's take a look at these. Let's take these 2 words. Now we've got the sort of economic viewpoint of those words, and let's look at that process. There are many identities, but one of the most important ones that we've talked about is figuring GDP. So remember, GDP is basically a combination of consumption, investment, government purchases, and net exports, which is basically exports minus imports. So if we take this, let's take a look at what we're really talking about here. One thing is that, just to let you know, for me, I tend to write GDP in the beginning. But you may find that the letter Y is used in place of GDP on many of the formulas in textbooks. But we also need to look at whether we're talking about an open economy, where we're talking about, we're interacting with other trade companies, or are we talking about a closed economy? Now, for this chapter, and often when we start talking about savings and investings, we really look at a closed economy. Now we look at a closed economy simply because it helps us analyze things a little bit better, helps us understand what's happening domestically. Because if we keep looking at all the stuff coming in and money coming in, then it gets a little harder to know what our people within a set border or country is doing. So a lot of times when we look at this in the beginning, especially as you're beginning your studies of economics, you're going to find that we're going to use a closed economy. So if there was a closed economy, then there'd be no trade, right? Because that's part of being a closed economy. We wouldn't trade with anybody. So our formula now takes out basically the import-export part. So we've got GDP is consumption, investment, and government spending. Now, if we look at the investment of the nation, just the investment, then we can remove consumption and government purchases because we're only looking at what is the country investing in. In that case, we flip the equation around a little bit, and those who've had algebra can see what's happened here. And basically, we would have that investment equals GDP minus the consumption minus the government spending, because all that would be left over in GDP if we took out consumption and government spending is investment. Now, what's interesting is that we can also say that investment is equal to the national savings. So we would write S for savings, and that S is equal to I. Now, S does not replace I. Why does S not replace I? Well, because saving and investing are different. Now, investing is when we're talking about purchasing new capital, so new equipment, new factories, new technologies. Savings is the money that you have left over after you pay all your bills, basically. It's the money that you put into the bank. It's that extra cash. Assuming you have a little extra cash, that would be savings. So investing is actually purchasing, making, doing something, whereas savings is what's left over after the bill. So we can't say they're exactly the same things as far as where that pot of money is, but we can say is that the savings of a nation equals the investments, because investments is what we talked about back in our lecture on GDP, is basically what we invest. It's the money left over that we invest to improve, you might want to say, an economy. So we could rewrite the formula to say that savings of an economy is GDP minus consumption minus government spending, because that would be the money we had left over. Here is the nation's productivity with GDP, the gross domestic product. And if we took out what we consumed and we took out what the government spent, all that's left over, as we said, was investment. And we said investment and savings are going to equal each other. Now, they're equal each other as far as amount, the amount. But remember, they are two different things. So we could rewrite this formula in this particular method. Now notice the second one that I wrote in blue has the letter Y where GDP is. And I'm going to be using that from now on for the rest of this lecture. So let's take a look at what this formula now tells us. So one thing about this formula is that it does not include taxes. And taxes is both money coming in and money going out. Now, the money going out we normally call transfer payments, because basically we're just transferring this good from one place to another. So Social Security, welfare, anything that's coming from the government to an individual is going to be a transfer payment. So any kind of stimulus, anything like that is basically a transfer payment, but it's coming from taxes. Now, one of the questions we always have to ask is, how does the government get money? After all, we just said that G is meant for government purchasing, and government buys a lot of things. Well, when we talk about government purchasing, we're talking about public savings, and that's the thing that's important here. That's the amount of taxes that's left over after the government spending is concerned. So G for government spending is really taxes minus government spending. And when we do this, if there is a positive number, then we have a budget surplus. However, if the government spends more than what they take in, we have a budget deficit. So understanding budget surplus and budget deficit is basically taxes minus how much the government spends. Now, when we say the government, again, just to remind you, we're not just talking about the federal government. We're talking about state governments. We're talking about county governments. We're talking about local governments. So G is just any government spending. But then there's the other side of the equation, because if you look at it, we were just dealing with G, but what about C? And also, what about a household? I've got to pay out taxes every year. Well, we call that private savings, and that's basically the income left after you pay your taxes and your consumption. So once you've consumed all your things and you've taken out your consumption, basically we're looking at this formula where Y, which is GDP minus T minus C, would tell us what private savings was. Now, if Y is income that's left over after taxes and consumption and spending, we assume that there's going to be something left over after these two things. It could come out to zero, but since Y is going to be generally a positive number for a country for GDP, then Y will be a positive number here. But if we pull these two things together, what we're going to find is that if we want to account for taxes and put that into GDP, we're going to basically have the formula that's down here. Now, the reason that we say that this formula is basically the same as this is that while we add taxes in here, we're taking taxes out here. So they basically cancel each other. So you may say, well, then why did I just spend the last 2 or 3 minutes going over this? You had something better in your life to do, because you have to understand what public savings is and what private savings is. So when we talk about public savings, understand we're just talking about this part. When we're talking about private savings of the nation, now we're talking about of the nation, not of the individual, we're talking about this part. So let's move on to some new information. As there's a market for bread and gasoline, there's a marketplace for loanable money. So we're going to create a simple model here to take a look at it. It's not a realistic model because of certain parameters that are in the real world that won't be incorporated into our model, but it gives us an understanding of how things work. So remember, we have Marco here who has some extra money. He's paid his bills. He now has some savings. So what he's going to do is he's going to take this savings and he's going to put it into this intermediary. So the intermediary's job, remember, is to connect savers with people who want investments. So this is Ramona. She's decided to do some capital purchasing for her company. So she's going to get some money for investing from this financial intermediary. Now in our model, we're going to say that there's only one interest rate, that savers and investing both have basically the same interest rate. So the interest rate would be what we say is the price of the loan. In this particular model, then, what we have is our supply and our demand. The Marco is our supplier because he's saving, and Ramona is the demand because she's borrowing money to invest. So we will replace our picture of our building basically with a simple supply and demand model. With this particular model, remember that we've always said that where the two lines intersect, that is where we basically have equilibrium. And what that meant was that this was the location where suppliers were willing to supply and demanders were willing to purchase. So we're just making this up. We'd say that if the interest rates were 4%, Ramona would be willing to basically borrow $5,000, but also Marco may be willing to supply $5,000. So these two things have to intersect in order for this to occur. Now, the last thing I kind of really quickly want to talk about is something you may have forgotten, and that is about two different types of interest rates. We have the nominal interest rate and we have the real interest rate. Remember, nominal interest rate is sort of that advertised rate. So when you go to the bank to get a mortgage and they tell you that the mortgage is 3.5%, that's the nominal interest rate. But we know that money loses value over time. Basically, inflation kicks in. So the real interest rate is basically what the borrowing money rate is after we take out the inflation premium. In economics, we're much more interested in the real interest rate and not the nominal interest rate. So pretty much anytime you see the word interest rate, such as you see right down here in my little model right here, we are talking about the real interest rate. If for some reason we want to talk about the nominal interest rate, we're going to say nominal interest rate. But for most cases in economics, pretty much assume that we're talking about the real interest rate, which means is that we are not considering this inflation premium. Now that we have this simple model, we can apply what we've learned in an earlier chapter, the 3 steps to analyze equilibrium changes. In this case, we're going to look at government policies and how they could affect basically this simple model. And so the first policy we're going to look at is if they think about increasing savings. Because the concept is if we could increase saving rates, that would have more money for investment, which would increase GDP, which would increase our standard of living. So let's take Marco. Remember, Marco has $1,000 to save. So he decides to buy a 30-year bond at 9%. Now, if he cashes that bond in 30 years and he has no taxes to pay on it, he'd have $13,000. He might be very incentivized to take that $1,000 to save. But the truth is he's going to have to pay taxes on it. And the tax rate is about 33%. He's figuring he's sort of at the top of his income level. So that means he only made really, a little over 5,000, really not a whole lot for 30 years. The truth is that what we're talking about is the difference between the nominal rate and the real rate. So that real rate is only about 6%. And you might say, for that amount of money, that small increase, it may not be worth saving the money, which means that the government may need to come in and say, hey, we need to do something to help incentivize people to save. And so what they're going to do is they're going to have some sort of reform to the tax code to try to incentivize greater savings. In this case, they say, let's increase who can have an individual retirement account. Maybe right now Marco can't have an individual retirement account, but they're going to increase all the number of people who can have it. They're going to make the pool of people larger. And so what Marco now says to himself is, well, this may not be a bad thing, because right now, if I was to take that $1,000 and when I sort of cash out, I'm going to not have as much as I thought because I'm going to be in a high income bracket. But if I put it into an individual retirement account, then I'm not going to take that money out until I retire. And at that point, when I retire, I'll be in a much lower tax bracket. So much less money would come out of my fund, you might want to say. I'll wind up with more money. So we're going to take our initial model here and let's answer the first question. Is supply or demand changing? Well, notice we're only talking about Marco here. Marco is the supply. It doesn't really change what a business will do, so it's not going to change demand. So we know supply is changing, not demand. Now, is it going to shift to the left or the right? Will Marco be more likely to save money or less likely to save money? Well, he's going to be more likely to save money because he could save on his taxes. He could hold more money in the long run. And so what we're going to see is basically a shift to the right due to an increase in savings. And so we now have an S1 and an S2. Well, you can already see that we're going to have a new equilibrium point. The equilibrium point, well, that will move along the demand line. Now, the reason we say it moves along the demand line is because the savings incentive goes to all people, not an individual person, but all people. So it's going to shift that entire line over, which means we've got this new equilibrium point, but that also means that we're going to have a new, basically, interest rate and also a new amount of money. So if all this shifts, then what's going to happen is that your investor might be willing to, invest $6,000 into their investments, and Marco might be willing to save $6,000, but he's only going to get 3% on his money now. Now, at first you may say, well, this isn't very good because that went down as far as investment is concerned, but the amount of money went up. Well, again, we'd have to take taxes into consideration. Yes, he might be getting 1% less, but if his taxes go from 33% to only 20%, well, he's going to basically have an 11% advantage. So this particular policy would see this particular shift, but different policies will have different effects. So let's take a look at another type of policy and how that would affect our model. This time, let's look at if we have investment incentives. So the concept is that if companies invest more, then that would increase GDP, which would increase standard of living. So our government official is saying, hey, I know what we need to do. Let's give basically an investment tax credit to any company who's increasing their investment. Now remember, investment means that we're buying capital goods. So we're buying a factory, we're buying equipment, we're buying new technologies. I don't know why I always stumble over that one. But there's good old Ramona. Ramona over there has one machine, and because they're going to give a tax credit, she's now saying, I think I'll increase my machines to two. Now, that will increase production within her company. It may also increase employment. Now, I say may increase employment because it would depend on what the machine is doing. Would she have to hire people to run that second machine, or is the machine replacing somebody? But we're not making that argument right here. We're going to make the argument basically it's going to increase production, which should increase standard of living. So again, we're going to start with our basic model, and we answer the first question: is supply or demand changing? Well, Ramona is on the demand side, so we know that demand is going to be changing, not supply. There's no incentive for me to save more at this point. So how is that going to shift? Well, we know it's going to shift to the right because there's an increase in demand. So we have a demand 1 and now we have a demand 2. There's going to be more people wanting this money. So you may have already noticed the equilibrium point is going to now move along the supply line. Unlike last time when it moved along the demand line, it's going to move along the supply line. Why? Because all people in the marketplace, all investors in the marketplace are going to want to demand more money, but it hasn't incentivized people to save more or supply more cash. So as that new equilibrium point comes, what we find is that, basically she's going to want to have $6,000 worth of money now to buy that machine, but we also see an increase in basically interest rates. It's going to cost her more money to basically get that money, you might want to say. But she figures she's going to save that because she's going to have this tax credit in the long run. So while it may cost her a little bit more, in the long run, maybe it's going to equal out. But notice it also could incentivize people to save more, because in the last scenario, Marco was actually going to be making, only 3% on his money instead of 4%. But remember that while Marco may be going from 4% to 5% if he puts his money in, he's not going to get a tax break on this. So in the long run, his taxes may take out any of that extra money that he actually saved. So this is always kind of an interesting dilemma in that it looks really good on paper. The question always comes is, how does this play out in the real world? And so supposedly, if we reform the tax laws, it's going to encourage greater investment, which should, basically result in a higher interest rate, which hopefully would allow more people to invest. Now, one of the arguments is that really the people who get incentivized to invest are the wealthy, because they have ways to save on their taxes, whereas Marco's $1,000, he may not have a way to save on his taxes. So interesting dilemma, but having that simple model allows us to see basically the effect of that policy. So let's look at one more policy. Last, we're going to look at budget deficits and surpluses. Remember, deficit, we spend more in the government than we bring in taxes. Surplus, we spend less than we take in taxes. So we're going to start with budget deficits. How does our policies, if we have a budget deficit, affect us? Let's go back over a few things. We want to make sure you remember that national savings is basically the supply of loanable money, and that there was two parts to it. If you remember earlier, we talked about private and public savings. So S was this particular formula. Now the public was T minus G, so taxes minus government spending, because the taxes is the money that the government gets to spend. So the government budget doesn't really sort of affect demand if you think about it. It's really only affecting supply because the government is not interacting with private investors in this case. Now, private was Y minus T minus C, so GDP minus taxes minus consumption. So a change in government policy does change public savings, because if we have a change in taxes, then that would have a change in the public realm. Now, if there's a deficit, there are many things that could happen. One is taxes could go up, and that's where we really see maybe the biggest change in public savings. But we also might see the government reduce spending. And that may sound really good, except for remember, the government is the primary purchaser here in the United States. So if they're not buying things from the private sector, then that means that the private sector is making less money. Now, if there's a surplus, the government could decide to pay off some of its debts. So remember, it borrows money in the form of T-bills and other things. It also may say, you know what, we've got a little extra money, let's go fix some roads. In that case, they're increasing their spending, which means that it's putting more money into the private sector. So looking at our initial sort of layout here for our model, what would happen if we have a budget deficit? Well, the first thing is that we're going to see a change in supply. Basically, we've already said it's a change in how much money is going to be available. In this case, because there's a deficit, we have a shift to the left. Basically, there's going to be less supply for the government to spend because it has a deficit. Now, that would then mean that it would move along the demand curve, and we've seen this before. And what would be the overall outcome of that? Well, basically there would be less demand to borrow money because interest rates went higher. So the government would have to pay more for its loans. So if it has a T-bill at 4%, now I might have to incentivize you to give me the money, to loan me the money by saying I'm willing to borrow at 5%. But that may be good for savers because it goes up, but investors are saying, hey, you know, it's going to cost me more money now to invest in myself, so I'm not going to invest. So Ramona decides I'm not going to buy that second piece of machinery, you know, because it costs $5,000 and I'm not willing to pay 5% of my money. I'm only willing to pay 4% of the money. And so what we call this is crowding out. Basically, we can see a decrease in investments due to government borrowing because rates go up, interest rates go up. So what happens if there's a surplus? Well, you know, we're going to basically see sort of the opposite. We are going to see that supply changes, but we're going to see that it shifts to the right. And when it shifts to the right, what that basically means is that there's more money out there to supply, and so it's going to move along the demand, and we're going to see this new equilibrium point. Now, you may have noticed that we saw this before. This is the same thing as sort of when we increase savings, meaning is that we say, hey, there should be more savings out there, let's make more IRAs. So that is one way that they can increase sort of a budget surplus, is by basically also increasing savings incentives. So those are just three effects you might want to say by looking at how we have government changes on the financial system as far as the financial markets are concerned. Now, the financial markets are just like, as I said, a market for bread or for gasoline. Your supply and demand will affect the shifts in these things. Now, again, just because I want to end this up saying that this was a very simple model. We know it's a much more complex model than this, but this is just to give you an idea of how things work and how government policies will affect different aspects of the nation. Remember, you can catch part 1 of this lecture right here in the same playlist of economics. Until later, keep learning.